Welcome to the Personal CFO. Today we're going to be talking about why a double-digit return in the stock market might actually be bad news for long-term investors. And so I saw this article, good article, and I'm going to walk you through the key points here. And what it's talking about is the S&P 500 is up, and again, we're in July of 2023 right now, about 17% so far this year. Now, that's largely driven by the biggest companies in the S&P 500. The majority of the companies in the S&P 500 have not gone up at all. But the S&P as a whole, if you were to invest in it, is up quite a bit this year. We think, okay, how could that possibly be bad news? Well, the price of the S&P 500 is up. But what about the fundamentals of the underlying companies? So how are earnings, dividends, how are those doing inside of those companies? The price is just a matter of what we're going to pay for the fundamentals or the future cash flows on an investment. And as it turns out, while the S&P is up double digits, the earnings of the underlying companies are up about 1% in 2023. So what does that mean when you have the fundamentals, or how well are the companies actually doing? They're basically flat, maybe up 1%. And you have a double-digit increase in price. Well, if you owned the S&P 500, that's good news, because now you've got some gains inside of there when basically the companies aren't doing any better. So the price of the company went up, but the actual company, from an earnings standpoint, not going anywhere, or didn't go anywhere, at least in 2023. And it just means that your investment got more expensive. And if your investment gets more expensive, all else being equal, your future expected return goes down. Now, many say, okay, well, what does this mean for me? Look at your portfolio. If you own the S&P 500, you're essentially a buyer. And do you feel comfortable buying an investment that's gone up double digits when its underlying fundamentals are up roughly 1%? Right? That means you're going to be paying a lot more today than you were at the beginning of 2023. So in January or December, you might have said, here's why we own what we own. Well, that story has adjusted quite a bit midway through the year. Now that investment is quite a bit more expensive for the same underlying cash flows. Do you still want to own it? And make no mistake, when I say, hey, you're a buyer of any investment that you own, because every day you wake up and you can say, I can sell this or I can hold it. And if you're not selling it, you're effectively buying it every day. You're choosing to hold that investment. And the story of why you might own an investment changes over time. And it's not to say that you should be buying or selling the S&P 500, but what it is saying is midway through the year, there is a different valuation attached to the S&P 500. It is now almost 20% more expensive for the same cash flows that you bought in January. And so when you look at your portfolio and you say, is this as big of a piece of a portfolio as I want it to be? Do I want to buy more? Do I want to buy less? Whatever. More than anything, as I always say, it's important to know what you own and know why you own it.